Hey guys, it's Conrad Bobbyluck here, CEO of Investors Prime Real Estate and best-selling international author of Australian Real Estate Investing Made Simple. Welcome to today's video. I can't believe it's March. I don't even know what's happened to this year. Well, I know exactly what's happened. I've been really busy with my clients, helping them build large property portfolios. It's interesting because at the beginning of the year and the last 6 months of 2003, the clients that I've been working with the most are the ones that have five, six, seven properties, and they have a lot of equity. They know what the market's going to do. They understand property cycles. They know it's the best time to buy is at the bottom of the market. Plus, they've got a lot of buffers. They've got a lot of equity, which means that they were able to absorb those increases in lifestyle expenses, petrol, food, even their mortgages doubling. But because their rentals have gone up by so much, and some of the properties that I've sourced for my clients in the last 3-4 years, the rentals have gone up by 30 to 40% over the period of time, which is incredible. And I've never seen that happen to that extent before, especially townhouses in the Bayside and in the eastern suburbs. There's such a critical shortage of stock for rent and to buy for different reasons, which I've covered in my other YouTube videos. The rentals have shot up far beyond what the increases have been in interest rates. So my clients that have bought early at the right time of the cycle, kind of laughing all the way to the bank. The ones that are not in the market are the first time investors. They're pretty much staying out of the market and they're not buying anything because they're stressed financially. If they've got one home, they've seen their interest rates, if they had a variable rate, go from 2.5, 3%, up 13 times in the last 16 months to 6.5, 6.75. So it's kind of it's unfortunate that the people that should be really getting into the market are the ones that the ones that have no properties or zero or one house with no investment properties are staying out of the market, and the ones that really could cruise for the next 2 or 3 years without any problems are the ones that aggressively are buying up properties. So which is good. So I've been really busy just helping my clients buy multiple properties. I've been working with a select few people, and it's interesting. Out of my 400 active clients, I'm spending a vast majority of my time working with about 80 of them. And they're the ones that have 5, 6, 7, 8 properties that I could just keep accumulating properties and following the system and buying properties with no motion. And like I always say, fall in love with the numbers, not the property. What I mean by that is fall in love with the capital growth, rental yield appreciation, income demographic of the area, all the fundamental drivers that I teach, rather than the aesthetics of the property itself. And if you do that, if you stick to the fundamental formula, you'll do well. Today's video, though, is about tax, which is not a topic that I like talking about because the reality is of tax, the only people that talk about tax are broke people. And I really mean that. And I'm not judging people by how much income they're making, but the only people that I've ever heard talking about tax are people with less than $100,000 a year. The clients that I have that either have 10 or 15 properties or they're on $1 million a year never talk about tax. And the reason for that is because when you get to a certain level of income, your accountants can set up structures for you in Australia or offshore, which make all your tax disappear legally. So we're not here to talk about breaking any rules, but we're talking about legal structures, whether trust companies, when you're offsetting losses between trusts, or offshore structures, which are tax effective ways to manage your tax. So the only people that really talk about tax are people that make 100 grand, they're paying 20 grand in tax, and they worry about land tax increasing or things to do with the stage 3 implications. But I've had a lot of phone calls from those people, and really they're the ones who want to help the most, because ultimately, my surgeon clients that are on $1 million or 900,000 per year, or my barrister clients or my lawyers that are making a lot of money, really nothing impacts them because their houses are usually paid off, or they've got very low mortgages, they've got lines of credit, they've got massive buffers in place. The people that I really want to help are the people that are the average Australian battlers that are working 9 to 5 on average incomes of $80,000, $90,000. And for them, every dollar counts, which is true. And they're the ones that I've been having a lot of phone calls from and emails, which are my clients, asking me, what do you think is going to be the impact of stage 3 income tax changes that are being introduced by the Albanese government, which I want to cover today extensively. I want to unpack it. And specifically, I want to talk about what impact it will have on the property market from a very tangible perspective, and i.e., what impact is the new tax system going to have on people's borrowing capacity? Is it going to have any impact at all? Is there going to be changes in buying behavior? Which sectors of the market will be affected? That's exactly what I'm going to cover today in today's video. So stay tuned to the very end. And there's a special bonus that I'm going to give you at the very end, which is access to an online free education video course, which I think everyone should watch, because really we're going into the next phase of the property markets. It's very exciting times ahead for those who have the right level of education. If you don't have the right level of education, you're going to be watching in the next craziness occur, and you're either going to be watching it, sitting on the sidelines, or wondering what the hell happened. But you're going to be doing one of those three things. And the determining factor is always your level of financial literacy and financial education. Because remember, guys, the difference between you today and 2 years from now is the books that you read and the people that you meet. And you need to surround yourself with successful people, but you need to also cultivate your level of financial literacy to a level where you're very comfortable with numbers and investing. If you're not comfortable with numbers or investing, you're just going to operate from a perspective of scarcity and fear, which is avoiding anything new. And you're going to be stuck in that comfort zone. You'll never be investing, or you're going to be waiting for that magic moment where everything's perfect. Well, it's never going to come, and this is the reality. So let's talk about tax, and let's talk about the implications of tax. Alrighty, and before we get started, I just want to do a bit of a disclaimer. Nothing today that I'm teaching you is deemed as any financial advice. Everything is hypothetical or things that are basically working for myself and my clients, but I'm not here to give you any financial or accounting or tax advice in any way, shape, or form. And I'm making no guarantees that if you follow anything that I'm covering today's PowerPoint presentation on my YouTube channel, I'm not making any guarantees. The only guarantee that I'll make you guys, if you don't do anything, you're going to end up dead broke, asset rich at 65. One house paid off and probably a couple $100,000 in your bank account. And then 30 years of living left ahead of you, which means you're going to be on a pension, which is not a good way to live in Australia. So my biggest incentive with my YouTube channel is to really help people to be inspired to get into the property market. You don't have to do it through my company or use any of the services that I'm offering. As long as I can change your mindset and give you a bit of I guess, an insight of how things work, and you take action, then I've done my job. A bit about myself, you can go to my website, conradbobulak.com.au, and you can check out my YouTube channel. Please subscribe and like. And I want to thank you guys for following me. When I started the YouTube channel, I wasn't sure if anyone's going to listen to my videos. And now it's doing quite well. So I'm really, really happy with that. If I hit 100,000 subscribers, I will be doing probably 2 or 3 videos per week. So if you are liking what I'm producing, and if you want to have more contents from me, because I'm doing pretty much 1 video a month at the moment, if that, by all means, subscribe. And the more subscriptions I'll have, the more energy I will definitely channel towards my YouTube channel. My background is pretty boring. I wasted 4 years of my life doing a degree at Monash University, which consisted of drinking beer at the tavern and doing assignments with international students. Nearly did an MBA, more bad advice, but I thought I'd get into the real world and make some money. So my first job was working for Australian Unity Funds Management in financial planning. And then I worked for NAB in mortgage broking and in private banking. And now for the last 20 years, I'm a real estate agent that's running an investment sourcing specialist company where I source the best growth properties in Melbourne's best performing suburbs for my private clients. The most important thing, you guys, is with this YouTube channel, there's no vested interest. I'm not a developer. I'm not pushing a particular suburb or trying to make something look better than it is. I'm completely unbiased. And also, I'm a property investor myself. I've got a multi-million-dollar property portfolio. So I'm actually doing the stuff that you're doing yourself. I'm refinancing my properties. I'm talking to valuers, mortgage brokers, etc., etc. It's just that I've spent 25 years in the financial services sector, obsessed with real estate. So quarter of a century, guys, when you spend in one industry, and you can tell them on my gray hairs now, you pick up a few clues. And this is how we progress as a human race, is learn from people that have done it beforehand. My book as well, as I mentioned before, I'm an author. I want to thank you guys for supporting me. It's got #1 multiple times on Amazon in various categories. This is, for example, in real estate investments, in buying and selling homes. So both of my books, I've sold thousands of copies. And it's really humbling because when you publish a book, you're not sure if anyone's going to buy it apart from your mum. If you want to get a copy of my book, just jump onto realestatemadesimple.com.au and my finance book by going to you can get it anywhere pretty much. You can get it from Amazon, any bookshop, or online, or on eBay for $20, probably. I don't know. I'm just making it up. By the way, if you stay to the very end of this video, pardon me, I'll give you access to a 2-day recording on my real estate investing fast track weekend from a few years ago. It's 70% still current, 30% it's outdated because we've obviously moved into a different part of the property cycle. But this is really like you got 12 to 14 hours of contents there. It's all about finance, real estate, structuring. And I'll give you the link below. You can just literally, there's no opt-ins, there's nothing to pay. You just go in, you start watching at the moment you set up your private password and access. So I'll give you that at the end as well, and I'll cover more of that. Let's get into it. New stage 3 tax cuts proposed by the Albanese government, which is really something that was created by the Liberal government, and the Labor government said we're not going to be touching the tax system. The reason they're doing it is because it's a very desperate attempt to be seen to do something that actually gives some value adding to the Australian public, because the Yes campaign has failed miserably. We've wasted $368 million of taxpayers' money, and 61% of Australians said no. And that was going to be one of the pillar things that the Albanese government was going to accomplish. They failed at that miserably. And then after that, obviously, because of various economic reasons, which is the war in Ukraine, which created petrol prices to go through the roof, COVID-19, creating all the supply chains disruptions and all these various components, building materials going through the roof, 1,079 builders and developers going bust last year, financial year in Australia, which is unprecedented, including some of the oldest builders and developers in Australia have gone bust for the first time. All these things have created immense pressure on the average family's living expenses and budgets, and people are doing it extremely tough. Plus, inflation became a problem. It crept up to 8-9%. Now it's going, it's tracking at around 4, even 3.9%, which is really good. So definitely the monetary policy that has been initiated has kicked in by the Reserve Bank of Australia. It's a very blunt tool because it has a delayed effect and it impacts businesses adversely. There's a lot of cafes and restaurants in Melbourne that have shut down, unfortunately, because people's mortgages have gone up by 13 times, or there's been 13 increases in the last 16 months. And I've seen a lot of our clients, just for their PPR, the house they live in, where they started buying it for 2.93% interest only. Now they're paying 6.5, 6.7, up to 7%. So, and in Australia, it's a funny thing as a nation, we're so obsessed with ownership because we kind of link our identity to the suburb that we live in, that we will sacrifice everything, holidays, clothing, cars, but the last thing that will go is the house. So people will just keep pumping money into their mortgage no matter what. And in fact, now there's a massive critical shortage of rental stock, and there's a critical shortage of just normal stock being built and sold in normal suburbs. I mean, in fact, in Melbourne, in the suburbs that I'm operating in the last kind of 2 years, some of these suburbs have 30, 40, 50% less stock available on the market than pre-COVID times. So people are doing it tough. People are really struggling financially. And look, the government has to be seen to do something. And what they did was they created a new tax system, which I'm going to unpack today, purely from a property investing perspective, which has an impact on 13.5 million Australians, basically, who get a bit of more money in their pocket. But is that little bit more money in their pocket, does it make up for the massive increases in living costs? And does it impact their borrowing capacity? That's the answer that I'm going to unpack for you in detail. So if we look at just the normal tax brackets, this is from 24-25. This is basically the change. So from nil to tax-free, 0 to 18,200, you're paying no income tax, which is great. I remember when I started working in financial planning, that was about $7,000-8,000. The rest was taxable. So 19% you're paying from the moment you go above $18,201 to $45,000. You're paying 19 cents in the dollar, if you like, for tax. From 45,001 to 200,000, you're paying 30 cents in the dollar, and then 200,000 plus, you're paying 45 cents in the dollar plus. the Medicare surcharge as well. So you'd be paying, 46.5%. And pardon me, I've got a bit of hay fever. If you look at the basic salary before income tax in 2019-20, on $45,000, and this is how much you would take home. You take home 38,828, 20, 21, 22, 39,908, and then 24, 25, 39,908. So that's the amount of tax you end up paying. So you can see there, lowest income earners definitely have benefited from this. And look, even though the highest income earners are getting more money back in their pocket as a percentage of money in your pocket, and also not even percentage, the amount of difference that it will make in your lifestyle, because obviously $1,000 to someone that's on 45 grand is very different to someone that's on 200,000 from a discretionary perspective, if you know what I mean. Because a lot of people on 200,000, believe it or not, their lifestyle is not much different from the average person. In fact, we were having friends over during the break last year, and we were having pool parties in my house, and I was talking to a couple, and this is a perfect example. And I didn't even think about this, but the husband was on 280,000, and I won't reveal names or industries, and the wife was on about 250. They were earning over 500,000 between them, and I overheard the discussion with my wife that they were struggling financially, and I couldn't believe it. I was like, "You guys are rich." And they said, "Well, the thing is, this Connor got 3 girls in private schools, and that we're paying 45,000 per year after tax for them. That includes all the camps and all the expenses. Our mortgage has doubled. So it went from 9,000 to 20,000 per month on our house. And also, we've got 2 luxury cars that we purchased that are also eating into everything. So after that, and we have no tax deductions virtually to speak of. After that, we're literally struggling with the amount of money that's left over. It occurred to me that the average person, and they said, "Well, I don't know how someone on $80,000 a year can live." I said, "Well, the difference between 80,000 and 500,000 is they go to a public school and they have secondhand cars, and they're not paying for the school fees, no cars, and their mortgage is a fraction. But the actual expenditure on clothing and food, you'll find, is very relatively the same across the board. I'm sure some millionaires will splash out on food and clothing more, but the average person out there, even on 200,000, their life is pretty much comparable in terms of the buying behavior compared to lowest income earners. So, so you can see that, like from 2019, 20, that someone on 120,000, their net income in their bank account went from 88,000 to 92,000. And on 200,000, in 1920, 2019 and not 2020, you're making 136,903. And then you're making 148,409. So it's a $9,000 difference effectively plus for high income earners. So this gives you kind of a net figure onto the changes. But what I mentioned before, if you're on 200,000 and you got a $9,000 difference, even though it's 9,000 versus, let's say, on 85,000 you got $1,000 difference, the reality is that $1,000 could mean more for that person on 85,000 than the 9,000 for a person on 200,000 in terms of immediate impact on their lifestyle. That this is the thing that I want to stress. It's not just about comparing dollars to dollars. It's comparing lifestyles and what these people do and how it impacts their bottom line. So, like, for example, you have the big major 4 CEOs. They're getting 9,000 back net in the new changes. Federal Parliament surgeons, anaesthetists, all those high income earners on 200 plus. Financial dealers, they're getting 5 grand. Financial managers, HR, barristers. But if you look at like secondary school teachers, the difference is going to be $1,000. Plumbers, 876. Accountants, 855. Midwives, 845. TAFE teachers, 801. Registered nurses, 681. Primary school teachers, 594. Carpenters, 534. So it's going to be about $500, for the average person. That's the reality. So let's look at, from that perspective, what's the net impact on serviceability for these people? Because that's what we're doing this video about. The motivation for this video is to explain, are the new tax changes going to impact or have any impact and flow-on effect on the property market from a serviceability perspective? Well, let's have a look. If you're on $20,000, the old tax cut was $342. The new tax cut is $288. So you're better off by $54 in your pocket, which means your maximum borrowing capacity on $20,000 goes from $50,644 to $51,241. So you've increased by $597. It's nothing really, you know. 30,000 is the same, 3,500, 40,000, 6,450. 50,000, 918, 60,000, 11,825, 70,000, 14,214, 80,000. So it's crazy, guys. I remember 2 years ago, I was sourcing townhouses in Cranbourne West in Flicker Avenue for 435,000 to 475,000, which is the cheapest properties I've ever sourced. And they've gone up by nearly 150,000 since, just in construction materials. But I was selling those to people that were on 72,000, 68,000. Now, if you're on 70,000, your maximum borrowing capacity is 370,000. So it's virtually, 100,000 lower to 150,000 lower for the average low income earner. If you're on 100 grand, the old tax system, you pay 22,967 in tax. The new tax system, $20,788. So the income increase is 179,000, which is nice. For that, you could probably get a one-way ticket, or maybe one person go to Queensland for 4 nights as a package. Increase in borrowing capacity, 21,738. 120,000, increase in borrowing capacity, 26,638. So between 20,000 to 120,000, there is the increase in borrowing capacity is virtually non-relevant to the property market, because $26,000 on the $639,000 property is nothing. It's 3 bids at an auction. You can see that at 130 income, 33,000. Fast forward to 250,000, it's $45,000 increase in borrowing capacity. So if you're on 200,000, you can borrow just under $1 million, 996, and it's 45,000 increase. 250, you can borrow 1.194, nearly 1.2 million, and it's 45,000. So basically, the impact, without any consideration for what's happening in the economy or what's happening with living conditions or petrol or fuel, electricity, the new stage 3 tax cuts will have zero impact on anything to do with Melbourne property, because properties have gone up in BlackRock by 20% in 12 months. So who cares about, $45,000 increase? It's nothing, guys. It's zero. It's going to have nothing to do with anything. The increase in income, that's cool. But look at the energy prices. The next thing that's going to increase is health insurance premiums, which will be 2 or 3 grand, right? And the actual increases in the last 24 months on the cost of living, which is reflected in inflation itself, is peanuts compared to these increases. These increases basically are just a PR exercise to buy some goodwill with the 13.5 million Australians that are going to get an average of $550 to $850 in their pocket, and the rich are going to make between $5,000 and $9,000. Big deal. It really doesn't do anything for anything. See, in 18 months of Labor, food is up 9%, housing's up 12%. So have a think about the percentage increase. If you look at $1 million, housing went up by 120,000, where $1 million property, which is around here, your serviceability has gone up by 45,000. The biggest difference that's going to be impactful on the property market is a reduction in interest rates long term. We've got to go back from 6.5 now down to 3s and 4s, and that's going to be a massive impact on people's mortgages. Electricity up 20%, insurance up 22%, and I guarantee you health insurance is going to go up after this, and gas is up 27% because of the inefficiency of the new energy sector that we're relying on. We got to go back to and I'm all for renewable energy, but it's going to be introduced in a much more sustainable way and managed correctly. Otherwise, we're going to have blackouts in Victoria and in Melbourne like we already have. So the government is jumping onto this kind of environmental wagon too quickly, in my opinion. And I'm all for it, guys. I'm all for electric cars. For every 10 electric cars, my Mercedes-Benz AMG S63 is offset beautifully, so I'll just keep driving my my S63 and then drive your electric cars, guys. The better, the more the better. As a result, new research from Roy Morgan shows 1.52 million mortgage holders in Australia, which is 30%, are at risk of mortgage stress in 3 months to December 23. This period included an interest rate increase on Melbourne, coupled with the RBA rising interest rates by 0.25% to 4.35. Now, remember, that's the bank swap rate, which is what the banks use. So the RBA regulates the overnight money markets, and the banks use that money, that interest rate, to buy money from the overnight money markets to settle their daily accounts. The variable rate is usually around 2% above that. So if the bank swap rate's 4.35, the average variable rate, I should say, across the 4 major banks, which control kind of 75% of the mortgages, will be 6.35, 6.5. And so really that stress has created a situation where people are spending up to 60% of their annual income towards mortgage repayments. And the next thing is food, and they're letting go of holidays, clothing, everything else. The figure for December represents the highest level of mortgage stress to 3 months as the impact of interest rates increase followed through, but still below the record heights above 1.56 million mortgage holders at risk in both August and September 23, which is no good. So we can see there the number of mortgage stress now in December 23. And look, the numbers that we're getting now, I know it's March, but remember the best numbers are quarterly, especially these large numbers. So we're always looking back at data. The numbers like this that are week old are usually very inaccurate. It's always going to be, we've got to collect all the data. So the numbers of mortgage stress holders is extremely high at risk. Now number is 964,000, which is 19.8% of mortgage holders. Now that's extreme at risk. There's mortgage stress and extreme at risk, which is higher than mortgage stress. So remember, with mortgage stress by definition, by the way, so 30% are at risk of mortgage stress. Now, the definition of mortgage stress is a person that is 3 months in arrears with their mortgage, which means technically the bank can repossess their property and sell it. Extreme risk is if they're probably 4 or 5 already missed payments, which means they can just lose their house any moment. So you've got 964,000 mortgage holders, which is 19.8%, which are significantly above the long-term average height of 14.2%. So we're definitely seeing a lot larger numbers. You can see there, you've got the GFC numbers, which was extremely high, 28.9, the GFC 35.6, and you can see that December 23, 30.3, and then you've got extreme mortgage stress 19.8. So yeah, not a good picture. So we need those rates to come down. These rate cuts and the new changes that are proposed that are coming in on the 1st of July 2024, in my opinion, while it's nice to get some cash, it's going to be a good night out. It's not going to be anything to do with long-term financials. So the long-term solution is we've got to put pressure on the RBA to start cutting rates, but also keep intact inflation, where it is. People are stressed out there and they need help. And the best way to do it, guys, is to focus on accumulating wealth. Don't focus on paying off debts. Focus your energy on getting educated and buying investment properties, because investment properties give you equity and they give you lines of credit which you can use to sustain yourself, to buy cars, to buy time, basically. If you got $1 million of a line of credit, or even 100,000, think about how much money you can draw out from that property to buy time when things are tough. And then when things are better, you can repay that back or just let it go and capitalize it. As long as your rentals are going up, what do you care? That's it for tax, guys. I don't want to spend any more time on tax because it is a painfully boring topic. But my assessment of the situation is there is no impact at all on the property market in Melbourne. It's a joke compared to what people really need to increase their serviceability. The impact, however, will be when the interest rates go from 6.5 down to 3.5. And also we're going now from in the Heronswood White property clock, we're traveling from 6 o'clock to 7 o'clock, which we are at now. So we're going to the next growth cycle in Melbourne. And that's why you got to get the education, as I mentioned earlier, because ultimately the determining difference between people who make money and lose money in the next 5 years will be how much education and financial literacy you'll be able to accumulate. So one thing is I'm doing my live events again. We had a bit of a break, but now I'm doing them again, which is fantastic. So if you want to come down to the office in Melbourne, just check out realestateFastTrack.com.au for the latest dates. And I'll run about 6 of these 7 per year. When the market's hotter, I'll do 10 a year. It's a 2-day event live with Cameron Fisher from Changing Places Real Estate, myself, and Stephen McClutchy, Director of Loans Australia. Stephen's actually settled over $1 billion in real estate himself over 27 years, and he runs a very successful mortgage firm called Loans Australia. They've got access to over 158 lenders on their panel. So join us for 2 days of amazing education where you'll discover advanced property investing strategies. We're going to go through all the property cycles, where we are at the moment, state by state, with laser-like precision. I'm going to talk about the hotspots in Melbourne, because the hotspots that are happening now are not the same ones that happened last property cycle. So my projections, if you've been watching me on YouTube, in 2018-19, I made a lot of predictions about hotspots in Melbourne, like Blackrock, like Elwood, and they've gone up by 20 to 30%. This time around, it's going to be different suburbs, because some of the suburbs that I'm a big fan of, and while fundamentally long-term I would still hold money in those suburbs, they've gone up so much, the rentals will take years to catch up to the growth cycle. And so in order to justify buying in those suburbs, you've got to have a rental yield of around 4.5%. If you're getting a rental yield of 1% in the suburb, at the buying point, there's no point going into those suburbs, because, and remember, there's an inverse relationship between capital growth and rental yield. The higher the capital growth, the lower the rental yield as a percentage, not as a real amount of money. So if you've got an investment property that's 500,000, let's say, hypothetically speaking, and you're getting 25,000, or let's say 50,000, just to make the numbers close, very, very simple. So you're getting 50,000 rental per year, so $500,000 property, that's a 10% rental yield. Now, when the property goes up to $1 million and your rental stay here at 50,000, while your property has doubled up by 100%, your rental yield has halved, and instead of 10%, it's now 5%. And if property goes to 2 million, your rental yield goes to 2.5%. So there's an inverse relationship between rental yields and capital growth, and there's a delayed effect in rental yield cycles and property cycles. And this is a very important term to understand when you're selecting properties, because depending on when you buy the property at the right rental yield cycle, that could determine how quickly the property will become cash flow neutral and positive. And a lot of people are not aware of this. They just buy properties and they do their calculations at that point in time. I'm also going to show you the difference between townhouses, apartments, and house and land packages, the good, the bad, the ugly, which ones to avoid, like a Kenny G concert, and which ones to go for. And also, I want to show you how to pay off save years and slash tens of thousands of dollars of your current 30-year principal and interest home loan and get it smashed down into 10 years or less, depending on how many investment properties you buy. And also, we're going to talk about structuring, how rich people and advanced people structure their property portfolio, understanding DSR ratios, how the banks work out your serviceability, 18 powerful ways to supercharge your borrowing capacity, which people are not aware of, 19 critical questions to ask your mortgage broker, the 12 most deadly property sins that people make that I see all the time, and they max out with one property. This is why 73% of investors only have one property, guys, because they make the same common mistakes. They buy a house exactly the same within 3 or 4 k's of where they live, and then they max out with one property and they never move on to the number 2 or 3 or 4 or 5. It's got nothing to do with their income or serviceability. It's got to do with their due diligence and understanding the fundamental driving factors behind property in suburbs. We're going to unpack this in detail, understanding how to balance your property portfolio between cash flow positive, neutral, and negatively geared properties, and much, much more. So tickets are $47, guys. You also get a hard copy of my book at the event, which is Australian Real Estate Investing Made Simple. It's a very thick book, and also you get access to my online education as part of that book as well. And that in itself is amazing, because then you can go away and then just practice the information. Remember, repetition is the mother of skill. Also, for those who stayed to the very end, if you scroll down below, there's a link there on how to access my free home study, which is a recording of that event from a few years ago from 22. It's still 70% the same, except obviously the market update has changed, but also the suburbs that I recommended back then have already peaked and boomed, and I'm going to do new suburb recommendations. So the fundamentals haven't changed, guys. The structuring, all the fundamentals of lending, they've never changed in the last 10 years. The same thing. We've been doing this now. I've been educating people live for now over 15 years, and I haven't changed any of my structuring advice throughout the last 3 property cycles. However, what's changed is which suburbs to target, what type of properties to target. All those things are changing all the time, but the fundamentals don't change. And so if you want to get the fundamentals, jump onto that education right now. Just go scroll down below and you get the link. It's absolutely free. There's no hooks or anything. It's valued at over $497. You just put your name and email address. You can start watching videos. And it's super quick, 10 hours of video, and you get a 265-page manual that you upload. You can watch it on your phone, iPad, anything. And also for those of you who want to work with me, and all I'm doing, guys, is sourcing investment properties for my clients. If you want like a concierge for your property portfolio, if you want someone that can help you find the best options, perhaps you haven't got the confidence yourself, that's all I do. There's nothing that I charge for it. It's a service. I am a real estate agent. I get paid commissions from vendors like developers, like a normal real estate agent. So there's no fee for my service. There's nothing that I would charge you, and I will find you the best investment properties in Melbourne for capital growth. This is especially good for people that are interstate that don't understand the market in Melbourne. Melbourne is very complex. It's very fragmented. There are areas that are going backwards, that are becoming future slum areas of tomorrow, especially in the western suburbs. A lot of the house and land estates are a complete disaster. There's gangs roaming in those suburbs. People want to get out of there. So I understand all the intricacies of all the different areas of Melbourne, which areas you should be investing in, which areas you want to stay away from. If you want to invest in Melbourne, one of the best markets in the world, not even in Australia, in the world, definitely come and see me. We can do a plan, and I can we'll sit down on a Zoom call. I can turn an idea into a plan, into action. So you walk away with a real plan that is specific based on your income, based on your resources. Everyone's got limited resources, limited income. So it's a real plan. And look, I always say if you fail to plan, you plan to fail. You've got to have a written plan exactly articulating where you are, where you want to be, and how to get there, and how to re-engineer that into property acquisition. A lot of people spend years unnecessarily doing this, going from A to B, and losing a lot of time and money. And remember, you can always lose money. That's cool, but you can't afford to lose time, because time is a non-renewable resource. You can always get more money, but you can never get your time back. And I see so many people coming to my events at 65, and we just can't help them. They've missed the boat. You can't do a 30-year loan at 65. So as you get older, guys, your risk profile changes, and you just have to take less risk. I mean, if you're young and 20, you can take all the risk in the world. Your risk profile is very different from someone that's 65. Or so the older you get, you really have to get on this as soon as you can, because it is a get rich slowly scheme. It takes a decade plus with property. It's not something you can just jump in like crypto or Forex and make instant money on a daily basis. Okay. There's months and months where there's nothing will happen, and eventually you'll make your money. But it is a game of patience, and that's why those who get started early end up doing the best. So I'm offering you a 1 hour free consultation with myself on Zoom. You get an introduction to my team. If you need more good mortgage brokers, accountants, solicitors, I know everyone in Melbourne that's worth knowing in the industry. Over 25 years, you kind of, you pick up the best, the best knowledge about who the best financial planner is, who the best lawyer is, who the best accountant is. So, and I can use anyone I want. They're not my companies. I'm completely independent. So I can refer you to the best accountants, best mortgage brokers, and they will make a huge difference in your property portfolio. This is some of the people that I work with. Cameron Fisher from Changing Places Real Estate, probably one of the best property managers in Australia. Stephen McClutchy, been invited to the top 100 constantly in brokers. James Black, which is director of Branding Co. Accounting Group, looks after investors, very successful property investor himself. Joel the director and CEO of United Global Capital, financial planning company that specializes in property, and they're very pro-property. Anna from Baden Sachs Lawyers, Wills Estate Planning, Testamentary Trust, Colin Adno, who does conveyancing. He's settled many properties for me personally. Pasha, who's CSR Lawyers, fixes your credit file, and Brendan Frost, who does building inspections from Landmarks Inspections. So this is kind of what your team will look like. If you haven't got a team, I can assemble a team for you. They're all in Melbourne. They're in the top league of their game, and they will make things happen for you. Remember, you got to surround yourself with people that are much smarter than you and wealthier than you, and then things will happen for you. So you walk away with a real strategy, paint by the numbers from scratch. Now, to qualify, because the cheapest properties that I've sourced now are 639,000, and I've got properties up to $6 million and everything in between. The average townhouse that I'm sourcing now is 1.45, between 1.2 to 1.7, but 1.45 is kind of the sweet spot, where you're getting a really good property in the eastern suburbs or the Bayside. Under $1 million is very difficult, but like I said, you've got to be on 95,000 per year. That way you can borrow at least 700,000. Look, if you're on like 90, 89, 500, definitely. Like I mentioned to you, the cheapest properties that I've sourced is 639,000. So you have to be at least be able to buy one property. Otherwise, there's no point talking to me at this point in time. And if interest rates drop, your situation changes, by all means, be in contact. And you got to have at least 112,000 in equity or available equity in order to close a transaction, which is stamp duty and legals. For a couple, it's kind of like a 140 combined income. We can borrow 700,000 at least. Look, you need at least 800, 850 for a normal property. There are entry-level properties as well. And look, doing something is better than doing nothing. Like I've sourced properties for 600,000 and they grow at 5% per annum. And people go, oh, it's only 5%. Well, 5% on 600 is 30 grand a year compounded. Can you save 30,000 after tax as an individual person right now in Melbourne with all the expenses? Forget about it. Most people can't save 10 grand. Most people are living from paycheck to paycheck. So if I can get the tenants and the taxman to pay for the property, it's costing you nothing out of pocket, and you're getting 30 grand after tax in equity in the property every year, that's a smart way to operate. So if you're one of these people, by all means, jump in. All you got to do is email me directly, conrad@investorsprime.com.au. Just send me a quick email saying I want to speak to you. I want to book in a Zoom consultation, and I'll respond personally and I'll book you in and we can have a chat over Zoom. That's it, guys, from me. Thank you for tuning in. I hope you become very successful in property investing, and I hope to meet you in person at one of my future live events. This is Conrad Bobilac. I'll see you on the inside.